Hi, and welcome to Section 2-2, Analyzing How Transactions Affect Accounts. In our last section, we learned a whole new way of representing increases and decreases to a transaction. We now have a tool, the T account, and with our T account, we have any amount listed on the right side is called a credit, and any amount that's listed on the left side is considered to be a debit. With our three classifications, our first one being any asset, assets we learned increase as debits, so the normal balance is a debit, and the decrease to an asset would be listed on the credit side, or the right side of a T account. The only assets we've learned so far are cash, supplies, accounts receivable, and prepaid insurance. Our next classification was liabilities, and this is the exact opposite of an asset. Liabilities, they increase as credits, so the normal balance of a liability would be on the credit side. And liabilities decrease on the side opposite the normal balance. They decrease as a debit. So liabilities increase as credits, and they decrease as debits. The only account title that we've learned so far that's a liability is accounts payable. Very similar to a liability is our owner's capital accounts. They also increase as credits, so they would increase on the credit side, and capital accounts decrease on the debit side of the T account. So capital increases as a credit, decreases as a debit. The capital accounts or owner's equity accounts we've learned are capital, revenue, and investments. In Section 2-3, we're going to get a little bit more involved with expenses and withdrawals because they have their own separate technique as to how they increase and decrease. So we'll get into those in Section 2-3. So we'll just hold off for those for now. Some things to keep in mind as you're being presented with transactions in this section. Okay, there's always two actions for every transaction. Never one, never three, just two. And in every transaction, you will only have one debit amount. You will have only one credit amount. So one of each. So if you ever see yourself writing down two debits, something's not quite right. Same with two credits. If you have two credits, something's not right. One debit, one credit. Now get into the habit of listing your debit amounts first, then your credit amounts. Just kind of in that order. Debits first, credits second. So let's go with our first example today. On August the 1st, we received cash from the owner as an investment for $5,000. We've seen this before in Chapter 1. So let's think about what two accounts are affected. Cash and capital. So when cash increases, which is an asset, we know assets increase as debits. Capital increases as a credit. So let's try to list debits first and credits second. So we have two T accounts. We're going to list our cash first. So cash increases as a debit, so we'll list our $5,000 on the debit side, the increase side. And capital, since that increases as a credit, we'll list our $5,000 on the credit side, which is the increase for capital. So what do we have here? We have one debit, we have one credit. Good to go. In our next transaction, we have paid cash for supplies for $275. Both of these happen to be assets, so they're both going to be operationally the same way, or operational the same way. So for cash to be paid, we know that that would be a credit, since that's a decrease to an asset. Supplies, on the other hand, would increase, and that increases as a debit. So we're going to list our supplies first, since that is our debit amount. So we're going to label our T account supplies. We're going to show that supplies increases as a debit for $275. Our cash, also an asset, but that's going to decrease since we're paying it. So we're going to list that as a credit. So notice we have our debit, we have our credit for $275. We're set to go. Our next transaction says that we're going to pay cash for insurance. Once again, we have two assets here. If we pay cash, we know that's going to be a credit to an asset. Insurance, since we're gaining insurance, that's going to be a debit to our asset. So we know in this case, insurance will be listed first, since that's going to be our debit. So here's our two account titles. We're going to title the first account title as prepaid insurance. Insurance increases as a debit. It's an asset, so that it goes up as a debit for $1,200. Our cash, since that's a decrease, assets decrease as credits, so we're going to show that decreasing on the credit side. Okay, our next transaction, August the 7th, we bought supplies. That's an asset. On account, that's a liability. Okay, it's like a credit card. You buy it now, but you're going to pay for it later for $500. So let's list our debit first. So we're going to go with our supplies. So supplies increases as a debit by $500. Our accounts payable for Supply Depot, since we're increasing our debt, how much we owe, we're going to increase that as a credit by $500. So what do we have? Our debit and we have our credit. We're set to move on. Our next transaction for August the 11th, it tells us that we paid cash on account to Supply Depot for $300. Cash is an asset. Accounts payable is a liability. This tells me that we're paying off what we owe them. So let's list our debits first, our credits second. Well, to decrease accounts payable would be to debit the amount, and to pay cash would be to credit cash. So we'll list our cash first. Since we're paying cash, cash is going to decrease as a credit, and accounts payable is going to decrease as a debit. Okay, so technically our debit should have been listed first, but this is what our publisher gave us. So cash, it's an asset, it's doing the right thing. Our cash is decreasing as a credit, and our accounts payable, how much we owe, that is decreasing as a debit. So we have our debit, we have our credit, set to go on. Alright, let's move on to the activity that we are going to work together as a class on page 37 in your textbook. If you look at page 37, you'll notice that we have several account titles in our word bank, we'll call, and then we have our transactions listed below them. All we need to do is label the T accounts and show when we have a debit and when we have a credit. So we'll look with our first one, number April the 1st. Received cash from the owner as an investment. Well, that's going to affect cash, and it's going to affect capital. So cash, since we're receiving, that's going to increase as a debit. That's the one we're going to list first. So here's our cash. We know that cash increases as a debit, and this is for $5,000, so that will be listed first. Since it's received from the owner, that's our capital account. Capital increases as a credit. So we're listing our capital, and we're listing our credit amount as $5,000. So debits first, our credits are second. Looks good, moving on. April the 2nd, paid cash for supplies. Cash is an asset, supplies is an asset. If I'm paying cash, that's a credit to cash. And if I'm buying supplies, that's an increase, that's a debit. So let's list our debits first. Supplies increases as a debit, that's an asset. And we paid cash for that amount, so our cash to decreases as a credit. Both are assets. So we have our debit for supplies, we have a credit for cash. Good to go. April the 5th, paid cash, an asset, for insurance, another asset, for $75. Well, we know that cash decreases as a credit, and insurance, an asset, increases as a debit. So we're going to list our insurance first, since that's our debit amount. Insurance is going to increase by $75, and our cash is decreasing also by $75. Cash decreases as a credit, so we show that decreasing on the right side. April the 6th, bought supplies on account from Bales Supplies for $100. So, supplies is an asset, and they increase as debits. We bought it on account, that's debt, accounts payable, and our accounts payable increases as a credit, so that's going to be listed second. So let's list our supplies first. We gained supplies for $100, so our supplies increases as a debit, and our accounts payable increases as a credit. I have one debit, I have one credit in the correct order. So that's good to go. We're set to move on. April the 9th, paid cash on account to Bale Supplies for $50. Okay? So just like in the example we just saw earlier from the publisher, they're listing their accounts payable first, so we're going to decrease the amount of accounts payable by listing our debit. So accounts payable decreases as a debit, and our cash, since we're paying cash, that once again decreases as a credit. So we have our debit listed first, we have our credit listed second. Accounts payable decreased, our cash also decreased. Debit, credit. That's it for today for the word together. So you'll be working on your own by yourself. Also, the instructions are on page 37. And that is it for today. You will not have to worry about the application problem today, just the on your own. Okay, stay tuned for tomorrow for our section 2-3, where we're going to learn a little twist to how T accounts are affected by expenses and also withdrawals. Have a great evening.